This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant currency on the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we are going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to take a look at credit, from business development companies to high grade's worst year ever.
Plus, healthcare isn't immune from climate change risk.
But first, let's talk about the broader market for a second. It's been a really whippy, crazy couple weeks. What does that mean for the landscape of ETFs? There's a lot to dig through in this, so we want to get to Bloomberg Intelligence senior ETF analyst Eric Balchunas. I'm just curious to broad stroke this, Eric. How are ETFs handling this massive volatility that we're seeing, particularly when it comes to the bond market?
Oh, man, it's rough. So you look at most people are just buying treasuries, or in particular, the short end of the curve. So we call them cash-like ETFs. They're taking like $38 billion this year. Treasuries overall, Treasury ETFs, taking $100 billion.
Wow.
Their old record is like $60 billion. So we're like way beyond the annual record. It's pretty ridiculous. This is part of what my manager calls the Terra trade, which has replaced Tina, which is there is a reasonable alternative to stocks, which is basically that these treasuries now yield something. So you get more yield there, plus you are able to hide out a little bit until something is working in the equity market. So on one hand, Treasury ETFs have been the big winner this year, and floating rate as well. But on the other, a lot of people have come out of bond mutual funds. They have seen $328 billion in outflows, which is a lot. Part of that is they tend to have older investors in those, and I think some of them might just be done. They're not going to wait around till the Fed's done doing its damage. They're just taking their money out, possibly, putting it in a savings account or something for a while. But that's not a good sign, because there's more money coming out of bond mutual funds than are going into bond ETFs, meaning there's a net drain and suppressive force on the bond market via the funds world. But that's generally the state. I would say, honestly, the bond side has it the worst of anybody this year.
So is there a sense, just from historical analysis, Eric, do the ETF fund flows, are they just concurrent with the market, or do they lead or lag at all?
It's a good question. Occasionally they can be a little bit forward, like you can use them as an indicator, leading indicator. But mostly I think what they do is they just sort of take you into the mindset of the investor. And a lot of times what I try to do is talk to people in person or on social media, and I call that anecdotal data. And then I sometimes look at the flows, and I find they line up a lot. And so I think the flows just give you some hard data to put next to what we all are experiencing and seeing and thinking. That's generally what they do. They also sometimes can do things like, for example, this is a really interesting year where the dollar is strong, right? So currency hedged ETFs should be getting a lot of flows, but they're not. On the flip side, low vol is getting a lot of flows. Those are two trades that worked in the past. The currency hedge, people are not coming back in. For some reason, they're just done with that trade forever, I guess. Whereas low vol is getting a second bite at the apple. Remember, low vol was big 5-6 years ago, and then growth took over. Now it's popular again. So those are also some other things we can look at. We can sort of gauge the marketplace and find out, which types of strategies investors come back to after they, to protect themselves. And so it is interesting also just to find out what works in the fund marketplace, as well as seeing, what kind of sentiment people are doing. And one other thing we do is we separate the ETFs into ETFs used by buy and hold investors like Vanguard and Schwab, and ETFs used by traders like SPY and the Qs. And what those flows tell us this year is that the trading crowd is in a constant tug of war. There's big inflows into SPY and the Qs, and then big outflows. And they net out to zero every month. So that's interesting. The Vanguard Schwab lane, they have been taking in money as usual. So I like to separate them out, because as long as the Vanguard bid is there, at least somebody's buying, right? That's a pretty good sign. But the trading crowd has been split. They sometimes come in hard and hot and think there's going to be a rally. And then a lot of times they're burned. They get out quickly. And so those flows have been they're net zero, but a lot has gone into that net zero number.
So when it comes to, say, you mentioned the Vanguards, et cetera, from where the actively managed ETFs, like how are they doing? How are they holding up?
Well, there's all kinds, right? So the Cathie Wood active, not good. That's a growth fund trade everybody's following that. I will say, though, and I think we called this, the flows out of her fund are not really there. They're like, she's holding her own asset-wise, but the performance is bad. So she hasn't gotten a ton of new investors, which would make sense. Now, over on the bond side, there are short duration active bond funds that are doing good. JPST is the JP Morgan one, which basically says, look, we'll keep the duration under a year, but we'll go and try to get you a little more yield than a money market fund would. That's a popular area for active. It has been in the past and remains to be this year. And then, I kind of consider smart beta to be active. That's like ETFs that just buy value stocks or low vol stocks, as I mentioned earlier. And those have taken in $100 billion this year. So in many ways, active over the past 10 years has gone from like a discretionary manager who picks stocks as they feel like it. What they've done is they've turned that into indexes. So like a value manager might have a metric system where they use, price to book, a couple other metrics to determine what they like in a value stock. They just design indexes like that. So those, which we call smart beta, have taken in 100 billion. So I like to say active is not dead. It's evolving and it's going to different places.
Eric, awesome stuff. Love talking to you. Eric Balchunas, Bloomberg Intelligence analyst.
Coming up on the program, winter isn't looking good for large airlines. We'll explain why.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. It's 13 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, the summer travel season has come to a close. Now the question is for a lot of the airlines is how's their business going to play out for the remainder of this year going into 2023 to get a sense of kind of where the airlines are at the moment. We bring in Bloomberg Intelligence Senior Aerospace and Airlines Analyst George Ferguson. So, George, it was crazy flying this past summer. I mean, packed airports, packed airplanes, lots of canceled flights. Talk to us about the fall here. Is it going to get a little bit easier?
What we expect is going to happen is leisure is going to start to fall away as we get into the fall and the winter, and we're not going to see business come back as strong as we might have hoped for. I mean, when we last looked at data in August, business was back about 75% of what 2019 levels were. That was actually off the top tick closer to 80 in July. And so we think that as you get in again in fall and winter, when you need that business support for fares and for demand, we're not going to get it roaring back like 2019 and leisure will go away. And so we feel like fares are going to get softer going into the end of the year. Plus the Fed is working against us, right? They're raising rates, trying to fight inflation. It's going to slow the economy down. The average consumer, especially the consumer into the bottom end, is probably going to feel a tighter budget, and that probably takes some demand away there as well. So we think not as exciting as you get in fall and winter.
At the same time, though, aren't airlines running to boost capacity like crazy and like fix all the shortages and the baggage handler shortages and all of that? Like, is this going to be a cyclical pain here for these guys?
I mean, I think it may be for the next couple of years, right? Because the challenge will be that they're going to probably have great spring and summers with a lot of demand. And I think we'll see the demand fall off as you get into the winter seasons. Again, I think maybe for the next couple of years. So they have this challenge where they've got a surge for the summer season, and then they relax operations in the winter. I think you'll see employees fall away. Hopefully they use the time to train. I do think they did get better at producing, available seat miles as we got through the summer. But I will say they knocked down some of the schedule, and that's what helped them. And again, they'll continue to knock down some of that schedule as we get into fall and winter. We kind of see about 85% of 2019 levels, but we'll still see adjustments as we continue to look at the end of the year.
All right. So on the business travel, you mentioned kind of 78 to 80%. Is that kind of the new normal, do you think, going forward?
I'm not one of those that subscribes to the fact that business travel isn't gonna come back as good as 2019. So I still think it will. I still think there's a lot of pent-up demand at companies, to get your salespeople out there, meet the clients again. They haven't seen them maybe in a couple of years because of the pandemic. I do think some will peel away because of Zoom and those technologies, but I don't think 80, 75 is the right level. I think we'll get back up into the 90s or something like that, but honestly, it's kind of my gut feel on the whole thing.
Okay, so based on all that, which airlines in the U.S. are kind of best to manage this, and which ones are going to feel the most pain?
I think there's going to be a lot of competition for the leisure consumer and especially the low-end consumer. And I think we can already see it in some of the results for airlines like Spirit and Frontier, right? They're just not, it's going to be hard for them to make really great profitability when they're cutting fares to try to fill airplanes. Those airlines really need to have packed airplanes to get the efficiency out of their operations to be profitable. I think that's going to be challenging. Yeah, if you're United, American, Delta, you do have this returning business traveler that provides some support. We did see better business fares. Business fares didn't come off as much as leisure did the last time we looked at fares. We're getting ready to actually check in on fares again. In another couple of days, we'll get fare data. But business fares held up better than leisure, and I think that will support American, United, Delta. They don't have to fill the airplanes as full, I think, to be profitable. So I think it's the low end's going to be the challenge.
All right, so how about the labor force? Because, my plane would land at Newark, invariably an hour late. And then
first of all, you went to Newark. I think that was the
that's
that
probably
was the
my first
problem.
mistake.
Mm-hmm.
Although,
Yes.
Living 15 minutes away from it, kind of. But and then we sat, and I could swear we were on an active runway. Yet we sat some more, and we didn't get to a gate for an hour and a half. When is the labor situation from the pilots all the way down to the baggage handlers? When is that going to get right-sized?
Yeah, so this is the huge question. And I fly into Newark all the time. I love Newark, for the record. So I had the same experiences where I sit 45 minutes waiting for a jetway. Look, I think that you're going to see it in the broader economy, right? Everyone I talk to in aerospace and airlines right now has the same problem, and it's labor. Labor is just a huge challenge. And, the pilots are a bit of a challenge, but they're not as mobile. Lower levels of labor are very mobile. They're going places to get a better salary. They don't want to come to the airport at 6 a.m. and put the jetway out for Paul Sweeney or George Ferguson. They want to work from home like the rest of us do for a couple days a week or whatever. So I honestly think you're not going to see labor at the airport sorted out till the Fed sorts it out for the broader economy. Wow. And you tell me, I think that's sometime next year, right? Mid-year next year? I don't know. But that's going to be the hardest nut to crack, I think, on the airline labor front.
Talking about the demand side, one thing we didn't hit on with that was the stronger dollar and then the impact of overseas people coming here. We're literally all going to Europe right now. Yes. Can you model that yet?
We've built it into, I think, our assumptions. And I was just over in France for, a meeting with Airbus. And I'll tell you, there's Americans all over Paris right now. There's Americans all over everywhere in Europe right now. We stopped a couple different cities. Dollar is really helping that out. Look, I think the flows to transatlantic, it depends, right? If the euro's stronger, the Europeans are coming here. Dollar stronger, we're going there. And remember, the big airlines that cross the Atlantic are all in joint ventures. So they share, some of them share profits, some of them share revenues. So I think it kind of balances out. I think it has helped some demand going into Europe. We saw transatlantic fares a little bit better, again, than the domestic fares. We see more competition. So we think that will support it a little more. Asia's still really closed. I mean, China's very, still tight about letting people in. And that affects a lot of the demand around Asia. Asia fares are great. There's just no volume over there.
How about if I need a plane, if I'm an airline, can I get a plane? A new plane?
You can actually. I think you can. You may not be able to get the latest, newest airplane, but I'll tell you, the other day I was looking at parked fleets. American has a whole bunch of 737-8s that are parked. They're not using them right now. There are older generation planes out there. And look, if you look at what Boeing did, right, when Boeing kind of figured out that China wasn't going to be in the delivery skyline for this year, They went out and they got orders from Southwest and United on pretty short order and have been delivering into them already after taking an order, less than a year ago. Boeing wants to raise rates. I think there is the potential to get airplanes. Plus, Boeing has 280, last we checked, parked, completed airplanes sitting at airports around, the U.S.
Right.
You could go get one of those probably for a deal.
Nice.
There you go.
I'll take a
and
look
then
at
you have your own little
if I'm in the
airport.
market for it. All right, George, thanks so much. We appreciate it. Bloomberg Intelligence analyst George Ferguson.
Coming up on the program, climate change risks are growing. Let's take a look at how it is for the healthcare industry.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele. It is 25 minutes past the hour, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide.
One of the big areas of turmoil has been Hurricane Ian and the devastation that it's had all over Florida. It does provide us, though, with a way to look at how climate change risks, hence Hurricane Ian, affects the healthcare system. So let's dive deeper into this with Eric Kane, Bloomberg Intelligence Director of U.S. ESG Research. Can you draw the line for me on a hurricane like Ian to the risks in the healthcare community?
Absolutely. It's a great question. And what we see, of course, with a lot of the hospital corporations is a majority of their facilities, hospitals, are located in areas that are susceptible to increased frequency of extreme weather events, so Florida, Texas, et cetera. So what we did see when Hurricane Ian made landfall as a Category 4 storm is a variety of healthcare facilities had to evacuate. Roughly 15 evacuated, some of those belonging to the major corporations such as HCA and community health systems.
So what do these healthcare companies, just in general, need to disclose as it relates to climate change risk? Is it anything unique to them, or are they just kind of like a lot of other major corporations?
It's another great question, and I would say the thing that makes them unique is really, hospitals tend to be located in areas of high density, metropolitan areas. So when we look up and down, the coasts of Texas, Florida, South Carolina, North Carolina, we see a lot of hospitals in low-lying areas. So there was a recent study published that suggests in a Category 1 storm, and again, Hurricane Ian was Category 4, about 150 of 680 hospitals examined would flood.
Wow.
Of course, for a Category 4 storm, that number jumps up to over 300. So I would say the type of metrics that we would hope hospital corporations would disclose would be, the number of facilities that they have in these low-lying areas and general preparedness and resilience and how they are preparing for these increased storm events.
Are investors or credit investors demanding this at all?
I think investors certainly are. So if you look at some of the ESG disclosure frameworks out there, like SASB, for example, the Sustainability Accounting Standards Board, for healthcare corporations, they do look for companies to disclose, their risk of climate change, the physical risks, so number of locations that would be in low-lying areas. And unfortunately, these corporations haven't really followed suit in terms of disclosing that information, but certainly I think investors need that data.
So if I'm going to build a new hospital in Florida somewhere, I'm just assuming that it's going to be built to specifications that would deal with a Category 5 or hurricane in terms of a generator and, the strength of the construction. Is that in fact the case, or is it not?
So I think for new construction, certainly we would hope that would be the case. But a lot of these facilities obviously have been built longer ago in the past, so perhaps without that level of resilience in mind. One thing we did see in response to Hurricane Sandy, which hit the New York area several years ago and caused about $3 billion in damage to New York area hospitals, was the Center for Medicaid and Medicare Services came out with a new rule called the Emergency Preparedness Rule. And this was really an effort to get hospitals to better prepare for extreme weather events, for cyber attacks, things like that. And part of that is, planning of kind of your physical plant. So identifying what you can do to limit power outages, what you can do in terms of moving things above ground level, et cetera.
What about the other part of ESG, and that's like straight up CO2 emissions? You have to be honest, the hospital healthcare space is not on my radar in terms of those kind of emissions. I usually focus on energy, for example. What are they? Like, are they doing well from that metric?
It's interesting because what we see, according to latest data, is that the healthcare sector as a whole, and that includes more than just the hospital corporations, other healthcare providers, accounts for almost 10% of total emissions in the U.S., and globally about 5%. So if we were to consider the healthcare sector as a country, it would be the fifth largest emitter in the world. With that said, we don't see great disclosure from these hospital corporations such as Tenet, HCA, Community Health, and Universal. They are really not providing information on energy consumption and, in many cases, greenhouse gas emissions. And earlier this year, the White House introduced a healthcare sector climate pledge where they asked over 60 organizations to basically agree to try to reduce their emissions 50% by 2030. And what we see is the companies that I just mentioned are yet to sign that agreement, whereas a lot of other major healthcare institutions, in fact, have already signed that agreement.
Hey, Eric, thanks a lot. We appreciate it. Eric Kane, Bloomberg Intelligence Director of U.S. ESG Research.
Coming up on the program, a look at credit from high grade to BDCs.
You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. It's 39 minutes past the hour, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
As worries about financial instability continue to percolate in the market, one area of interest is credit. What's going to happen to high yield? What's going to happen to investment grade? Let's ask Bloomberg Intelligence Chief European Credit Strategist Mahesh Bhimalingam. Mahesh, talk about the European credit market. Is it functioning properly right now?
Thank you for having me again. Is it functioning properly? I think liquidity is not as great. So in terms of functioning, you check trading flows, you check issuance, and then you check fundamentals before we think of returns, right? So liquidity has definitely dried up. And that shows up in, let's say, if you look at cash CDS basis, that has blown up. If you look at issuance, given how wide yields are, both investment grade and junk, investment grade is at around 4%, and high yield is around 8.5 plus right now. Remember, in Europe, last year, we were at 30 basis points investment grade yield, and we are at 4% now. So we are talking about 13 times wider yields. It was quite spectacular. In the high yield is about 3 times wider. So with such extraordinary yields, which are more than double existing coupons. Now, why am I talking about coupons? The average coupon is what you pay as your current borrowing cost, right? So as your bonds mature, you will have to borrow at the yield to replace them with new bonds. But if you have yields more than double, unless someone is forced, nobody's going to issue. So what is happening is, thanks to post-pandemic glut of supply, most corporates don't need to issue. And as a result, supply has completely dried up.
Yeah, it's just amazing. I mean, just taking a step back, coming up in a business, a lot of folks heard about the 60-40 portfolio, and that 40% of your portfolio in fixed income, that would cushion some of the volatility of the equity side. That did not happen this year. How did we get to the point where we have double-digit declines in total returns pretty much across the fixed income space?
To answer it in one phrase, the golden age of fixed income is over.
Okay.
Wow. Okay.
No, it's very important to realize. So if any one of us plots the 10-year treasury yields from about 1970 to end of last year, it has been a secular decline, except for a few blips here and there. The decline is very clear. Now, you're going to have, thanks to Putin, thanks to QE, thanks to too much fiscal stimulus, you're going to have enduring inflation for some time. So you're not going to get back the 2020 and 2021 golden days again. Those days are over. Which is why you are seeing this spectacularly horrible returns in both investment grade junk. By the way, we are not even mentioning rates. Rates, it is even more of a dreadful story because much longer duration and much bigger widening. So those guys have lost at least 50% more than us. When we talk to strategists, we keep hearing things like at some point we're going to get back into the fixed income market because you're finally getting paid on treasuries. I talked to distressed guys and they're like, we still like credit. Obviously, the better credit, like triple Bs or something, but we like credit because you're going to get a lot of yield pickup. Do you not think that true buy the dip is going to materialize in a meaningful way? Okay. Now, Paul's question was more of a long-term thing. Like, why are we seeing these double-digit 20% sort of losses? Mm-hmm. That's the reason that I've explained. Now, are we cheap now? Still not yet. This is what we've published, right? Both high yield and investment grade, yes, they've sold off. But given the extraordinary volatility in the market, you are still not being compensated enough. So investment grade is around 1.6 standard deviations wide. Junk is less than that. It is 1.4 standard deviations wide. So is credit cheap? Yes, it looks wide optically, but once you normalize, it is not. So we probably have another chance of a widening. I'm not saying that it will happen, but it is not in a slam dunk buy territory. It was, by the way, just to clarify, it was in buy territory at the end of June.
So if we look at the sectors here, Mahesh, which are the ones that kind of really underperformed, that just kind of were some of the worst performers out there?
I don't think we should talk about a month. Let's talk about the year.
Year to date, yep.
Year to date, the worst are typically in financials, the ones that tend to have long-dated issues. REITs is by far the worst. REITs, other financials is basically, car companies, finance, that sort of stuff, GE, that sort of stuff. Or you have long-term utilities. Duration has basically really, really suffered. So if you are shorter duration, you do okay.
Well, it's going to be a really difficult environment, particularly if you're an investor and trying to buy that dip long term is going to be tricky too. Mahesh, we appreciate you joining us on this. Mahesh Bhimalingam, Bloomberg Intelligence. Thank you.
Right now, we turn from high-grade credit to business development companies, BDCs. This is something new for me. I can't wait to figure out what all this is. For more, we're joined by BI credit analyst David Havens. David, just for me, and I think for a lot of our listeners, can you define what a business development company is?
Yeah, sure thing. And it's good to be with you. A business development company is something that was mandated many decades ago by the federal government. It's a regulated financial institution that's charged with making loans to smaller and mid-sized companies, generally less creditworthy companies. And I think the intention, of having business development companies was for, banks to go after the higher quality companies, and business development companies would be an entity that would be able to lend to lower quality companies and provide credit.
So are we talking about like Blackstone, Ares, certain areas of KKR? Like, are these the kind of names that we're talking about?
Yes. So something that's become very popular over the past 5 to 10 years is alternative asset management companies pushing into the business development company world, and it makes a lot of sense. A lot of the sponsors that the alternative asset managers are working with are focused on smaller and mid-sized companies. Those companies need credit, and the Blackstones of the world can form a business development company. They can essentially fund it with other people's money, and they can earn an attractive spread or management fee on the assets in the business development company. And at the same time, they can actually fund some of the businesses that they themselves and their sponsors are investing in.
All right, so I would think with what's happened so far in 2022, we've had the capital markets and the public markets have effectively shut down, particularly on the equity side. So does that mean there's more demand for some of these private credit providers?
There's always been demand for private credit. I would say that it's probably at a higher level now because of the problems in the public capital markets. These private creditors continue to have good access to funding. They've been able to raise a significant amount of equity capital, a significant amount of debt capital, and they can put that capital to work and earn a very significant spread right now. And one thing that I sort of think about is when you think about the credit markets, it's kind of like a ski mountain. And if you ski, you look at your lift pass, and there's a warning that there's basically danger everywhere on the ski mountain. The banks tend to operate on maybe sort of the green slopes, the blue slopes. Every once in a while, an out of control skier will come and mow them down, and I think that we're seeing a little bit of that going on right now. The business development companies tend to focus on the expert terrain, but they do so with good recon. Mm-hmm. They basically have an avalanche pack, in the event that there's something that comes up, and they're ready for what will come next.
In this environment, when rates are going up, you're going to have traditional banks kind of retrenching, pulling back a bit. No doubt the Brightspeed and the Citrix of the world is going to scare some banks because they're going to be left with stuff on their balance sheet. Like, is this like the perfect world for these kind of companies?
Well, again, keeping with that ski mountain metaphor, there's a storm and visibility is limited. These guys know where the dangers are. They know where the opportunities are. They know where the powder stashes are. And in this sort of marketplace, it's going to be a powder day, and they're going to have a good time because they're going to be able to clip some pretty nice coupons on some of the capital that they extend.
Mm-hmm. All right. So if we are, in fact, either in a recession or heading into a recession, I think about the middle market being more at risk from a credit perspective,
exactly.
or credit quality perspective.
Mm-hmm.
What have you noticed over your career about these kinds of cycles here, and what some of these private credit lenders might be dealing with?
Yeah, no question that's an issue. The largest business development companies, the higher quality ones, tend to operate in the higher echelons of structure. For example, if you look at some of the Blackstone entities, 98% of their loans are senior secured loans. So they're in the highest structural elements of these riskier companies. If you look at the 15 years that Blackstone, for example, has been involved in private credit, they've averaged 11 basis points of losses per year on their credit portfolio. So that doesn't entail every cycle, but it entails a couple of cycles and a couple of setbacks in the economy, and they've performed well. But definitely if we get into sort of a traditional recession, some of these smaller mid-sized companies are going to have troubles, and there's no doubt that there's going to be an increase in credit losses for the BDCs. Mm-hmm. But the BDCs are a lot less levered than banks. The average bank probably has a leverage ratio 10-to-1, 8-to-1, something like that, of assets to equity. These guys have less than 2-to-1.
All right, David, good stuff. Really appreciate it. Learning about BDC's business development companies, some good stuff. Our thanks to Bloomberg Intelligence analyst David Havens.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries.
And remember, you can access Bloomberg Intelligence via BIGO on the terminal. I'm Paul Sweeney.
And I'm Alex Steele. It's 57 minutes past the hour, and this is Bloomberg.